Hello and good morning, everyone. Hopefully everyone can hear me. My name's Carlos. I'm the creator and administrator of our Robinhood stock market watchlist group. Every Sunday morning, we have just a little training and slash kind of meeting thing that I like to do that kind of helps, pump me up, but it also helps pump you guys up too. That way we can we always go over the basics, but also kind of look at the most advanced or most active stocks, as well as other information, news, but also most importantly, learn how to plan our week ahead. So that way we always know what each day is going to be like. So that way we know whether it's going to be bearish or bullish. Now, I've been in the stock market for almost about 15 years now, but it was more or less long term. But I decided about 4 to 5 years ago, get more heavily into active trading, short term. Then I went to swing trading and then day trading. So I've really decided to really get into knowing everything about the stock market, how it works, what affects it, and I just really wanted to master everything, and so we're really going to learn a lot today. This is going to be kind of an information overload. If this is your first time, I would definitely, if this is your first time here in this meeting, I would definitely recommend taking a lot of notes, because the more you learn, the more you're going to earn. Because we're going to go over a lot of things that a lot of YouTubers don't talk about, or a lot of other people don't talk about or mention, because this is very highly intelligent, advanced information, and for some reason it just doesn't get a lot of attention. Where a lot of YouTubers and authors will try to create things that's going to create a lot of views, a lot of clicks, and a lot of attention, and a lot of times, for some reason, intelligent information just doesn't get a lot of audiences. So the first things first is going over the basics. I call it the advanced basics. This usually takes, this usually takes about an hour. Then after that, then we'll kind of go more over the planning our week ahead and active stocks and whatnot. But there's all different types of investors. You have your long-term, you have again your short-term swing trade, day traders, and then you have your options. But there's something that they all use and have in common that helps them make them successful and maintain consistency. Because consistency is really, really important. That way you're able to take advantage of any type of characteristics, whether it's bullish or bearish characteristics. But the one thing that we all have to master first is something called moving averages. Moving averages helps provide us our buying and selling signals. Without them, we'd be trading blindly. We'd be throwing money at something and hoping that it sticks. And that's what I call the hope system. And we want to avoid using the hope system. We have to know everything, or as much as possible, because if we don't know, we're just gambling. We're just throwing money at something and hope that it works out. Now we're entering the bearish season, so we're going to see a lot of red days coming up ahead for several reasons. Not only is the world leaders kind of pouring fuel on the fire, making the situation worse, but coming into December and the first quarter, well, first off, we have December really right around the corner. That is going to create a lot of volatility, because it's the end of the year. They're going to talk about inflation. They're going to talk about starting increasing interest rates. Then we have this new COVID variant. So there's just a lot of things that's coming ahead. Not to mention the triple witching day, which happens on Friday, December 17th. And so it's just a trifecta of bad news. But as long as we can know about it, we can take advantage of the situation, especially with options, which we'll get more into here in a little bit. We can bet against the stock. So if the stock goes down, we can profit tremendously from that. But we have to know and master the basics. So first things first, I'm gonna pull up a video that is going to go over the moving averages And it's just a couple minutes, and then we can switch over to Weeble, which is one of the stock market platforms that I use. That way I can show you how to configure your moving averages accordingly to your style or with your strategies that you use. So I'm going to switch over here to this video. Again, this is just a couple minutes.
The moving average is one of the most commonly used technical indicators. If you've spent even a little time looking at price charts, you will have noticed that most often the price of an instrument will move up and down. In fast-moving markets, you may find that the price may be surging up only to plummet moments later before surging up again, increasing the potential for false signals. The moving average can help filter out the noise from random price movements and smooth it out in order to see the average value. Moving averages are used to identify trends and confirm reversals. When the price is above the moving average line, we consider the instrument to be in an uptrend. Conversely, if the price is below the moving average line, we consider it to be in a downtrend. The breaking of the moving average line usually implies a trend reversal. Moving averages are also used to identify areas of support and resistance. Many traders will consider the moving average line as a support and resistance level indicator and base trades on it. So traders will check to see whether the price is going towards the moving average and see whether it will bounce back from it or break it, as with regular support and resistance level. Oftentimes, the price of an instrument will find support at the moving average line when the trend is up, and will find resistance at the moving average line when the trend is down. So moving averages will tell you whether an instrument is trending up, down, or if it's ranging. It can tell you if a trend is still in motion and whether it is reversing or losing momentum. Have in mind that a moving average is based on past prices and is known as a lagging indicator. Therefore, it will not warn you in advance, but it will confirm when a trend change has taken place. At the most basic level, when the price crosses up and over the moving average, traders take this as a signal to buy. When it crosses down under the moving average line, they consider it a signal to sell. Let's take a look at the types of moving averages. There are three main types: simple, weighted, and exponential. We will discuss the simple moving average, or SMA, first and show you how it's calculated so that you can adjust it according to the given market circumstance. So if you wanted to plot a 10-day simple moving average, you would add the closing prices of the last 10 days and divide by 10. This calculation gives equal weight to each day. It's called a moving average as the oldest price is dropped each time a new period becomes available. In this way, ensuring that the average is based only on the last X number of periods, in our example for the last 10 days. Have in mind that the longer the simple moving average period, the more it lags and the slower it is to react to the most recent price movement. And this brings us to its downside. As equal weight is given to all periods considered in the calculation, the simple moving average is slower to respond to rapid price changes that might prove to be important. So how can you counter this? With another type of moving average, either a weighted or an exponential moving average. The weighted and exponential moving averages are calculated differently from one another, but both types give more weight to recent periods and thus more emphasis on what traders are doing at the moment. So as a result, weighted and exponential moving averages respond faster to price action by distributing more weight to recent periods and less to older periods. They reflect a quicker shift in sentiment, which can be due to changes in supply and demand or important news events that impact the traded instrument. To illustrate what we mean, if you were to plot an exponential moving average and a simple moving average on a chart, you will see that the exponential moving average is closer to the current price than the simple moving average. Apart from the type of moving average, you also have to decide on the time period. This will largely depend on the type of trend you are analyzing. Here are some guidelines for commonly used time periods: 10 to 20 for short-term trends, 50 for mid-term, and 200 for long-term trends are typically used. When and how should you use moving averages? Deciding which moving average to use and the time period will depend largely on your objective. Use exponential moving averages for shorter time frames, or if you're analyzing a fast-moving market, as you'd have more emphasis on the latest prices. Use simple moving averages if you are planning on holding a position for a longer period of time, as the exponential moving average might be too sensitive and give false signals. You should also use simple moving averages if you'd just like to filter out the noise from random price fluctuations to determine the overall market direction. Thank you for watching this tutorial on moving averages. Our next...
All right, I'm going to rewind this and let's go back. I want to show you a very key thing right here. Look at that right there. Again, this is what moving averages is. It is it's basically your assistant that's trying to communicate with you, letting you know certain signals, whether the stock is getting ready to trend down or up. But at the same time, you have to kind of mentally visualize these signals when they cross over, when these lines cross over each other. So which we'll dive into Weeble here in a little bit, but basically your mind has to let you know, okay, bam, there's a sell signal, bam, there's a buy signal, and then you ride that wave up until it provides you another sell signal or a buy signal. So very, very important. And I'll share this video with you guys here in a little bit, because I highly recommend watching this every day, if not several times a day, until you have every little bit of it memorized and until you have it mastered, because it's only going to make you better. Practice makes perfect. So let's switch over to Weeble here really quick, and then I'll show you more about the moving averages and then how to configure it based on your style. Well, and there's a lot of different things we can see right now. I got Shiba on there. We can also look at Bitcoin, but let's take a look at like Facebook, for example. Facebook is right here. This is the daily graph. So every little notch is 1 day. Now, a lot of times you'll see people using candles or whatnot. I don't like using candles because to me it's a little distorted. It distorts the picture. I need to see a very clear, like 20/20 vision of what's going on. Now, a lot of the information in the candles I can see right here. We have the colored bars with the red and green. Red obviously is the majority of selling activity. Green is the majority of buying activity. The height of the bars is your volume bars, so it just lets you know how much volume activity there is for that time or day. And so, but if I right click on it, you can also go to line style. You can click on candles, and that's what it would look like. And again, you can see how kind of more of a blurry, vision. You're just not quite sure. And that's why I like using the lines, because it's just a much clearer picture, but I can get the same type of information on the candles right down below here. Now, I use Emma for the graph, as the video has mentioned. That there's a couple different types of moving averages, and basically, as the video had mentioned, that they're weighted. Basically what that means is that the different moving averages will react quicker or slower to the price movements. And so if you are a long-term investor, you would want the moving averages to react slower. So that's where you would want probably just the MA or moving average indicator. But if you're more of a swing trader, day trader, you're going to want more of a reacting moving average, and that's where I use the EMA or exponential moving average. And so on your device, whether it's your tablet or your mobile device, you can just click on it. It's just right up there, and then all of a sudden the little gearbox, that's your settings, that will appear if you're on your desktop, that you can download from their website. You just click on it, and then the gearbox appears. And then this is where you'll have your indicator settings, and then you have your main chart, which you can only pick one, and then down below you'll have your subcharts where you can pick up to 6. Now, I use MACD. Both your moving averages and your MACD, those two indicators are the most used, most popular indicators used by a majority of successful investors and traders. So if they're using it and you're not, then you gotta try it. In order to get different results, you have to try something different. And so this is all just part of the system and the tools that you just have to have under your belt. And so the MACD, basically, you can see where the Facebook price line was above the moving average lines. And so over here, as it starts to cut down, it's basically providing you your selling signals. It's time to sell. Now the MACD on the bottom kind of gave you that warning prematurely. It's just saying on this day here, September 13th, it's like where you can see this bar is red, where the previous one was green, and then the lines begin to touch or cross over prematurely. But it took a couple more days for the on the top graph for the price line to actually do that there, where the MACD was letting you know ahead of time, what's going on there. Now the MACD is basically two moving average lines. There's no price line on the MACD, but there's two moving average lines, one slower, one's faster, but the colored bars are basically your gap bars, letting you know how much of a gap that there is between the two moving average lines. So as you begin to see a shorter gap, that means it's slowing down. The price movement is slowing down and is beginning to reverse. And so we can see that we've been kind of having some issues lately, mostly because it's the holiday weekend, and then with the with the news that happened last Friday. But it's just kind of ranging right in this area here for right now, and that's common. But we need to see a good signal for it to really give us an idea of what direction that it's going to go. But we'll talk about patterns too later on here shortly, so that way we know exactly what these patterns might look like. But again, moving average, very, very important. And then if we go back to the settings here, we have our indicator settings, and then when you select your desired chart, on the right you'll see lengths. You have 5, 10, 20, 30, 60, 120 length. These are basically trading days. So you have 5 trading days, which would basically be in 1 week. We have 10 trading days, which would be basically in 2 weeks, and then we have 20 trading days, which would be 4 weeks or 1 month. So you have your 1 week, 2 weeks, 1 month, or if you're looking at a 1 minute chart, it'd be 5 minutes, 10 minutes, 20 minutes, or so on. And you can reconfigure those if you wanted to. Those are default, but they're very common settings. But then you can click on style above and pick and choose what lengths that you want, and you can change the color, especially if you wanted to personalize it, or maybe if you're colorblind, maybe you can't see certain colors. You can change that and personalize it to your preference. And so but you can play around with a lot of this stuff. Just make sure you definitely have MACD as part of your subcharts, and if you have any questions, just let me know. So we're going to tune into the second video. Again, it's only a couple minutes long. Give me a moment while I pull that up here really quick. And then if you guys have any questions, I'll be able to answer those for you.
We will now.
Hold on here. All right, here we go.
We will now build on material covered in the first tutorial on moving averages, where we defined what a moving average is, the 3 types of moving averages, and how they are calculated. In this second tutorial, we will discuss how to use moving averages to identify the direction of a trend, how they can be used to enter and exit a trade, and finally, how to trade moving average crossovers. To determine the direction of a trend using a moving average, you must take into account the set time period. We touched on this briefly in the last video, where we showed you the most commonly used time periods when analyzing short-term, mid-term and long-term trends. But why is it important to be aware of the time period of the moving average? In this chart, when we place a 20-period simple moving average by clicking the indicator icon and setting the time period to 20, we can clearly see that it indicates an uptrend. Yet when we place a 60-period simple moving average in the same way, we see that it shows the price in a range with no clear upward or downward trend. The difference in the direction of the trend portrayed by the moving average is due to the time period. Shorter period moving averages are faster at generating signals, and changes in the price of the instrument will be reflected more quickly. The longer period moving average will react to price changes much more slowly, but will generally provide more reliable trading signals. As a trader, moving averages will help you decide which way to trade by looking at whether the price is above or below the moving average line. In this chart, the price is above the moving average line and acts as support. You could buy and enter a long position when the price pulls back to the moving average line. You could then place your stop loss underneath the moving average. Here we can see the opposite. The price is below the moving average and acts as resistance. You could then enter a sell order when the price retraces to the moving average line and place your stop loss above the moving average. The interesting thing about moving averages is that they can be used alone or in combination with other moving averages. So when you place two moving averages on one chart with different periods reflecting a short-term and a longer-term trend in price, you have the opportunity to trade moving average crossovers. They can be used to determine when a trend has changed direction. Let's show you what we mean. On a daily chart for the pound US dollar, we will now place a 10-period simple moving average and a 20-period simple moving average. When a shorter period moving average crosses above a longer period moving average, it can signal that the trend is changing direction to the upside and it may be a good time to buy. When a shorter period moving average crosses below a longer period moving average, this is considered bearish, a signal that the trend may be changing towards the downside and it may be a good time to sell. No matter which two time periods you use, this principle will remain the same. To recap, a moving average is a lagging indicator that can help filter out the noise from random price movements to see the average value. It can help identify the trend direction, determine support and resistance levels, and can help confirm a trend reversal when looking at moving average crossovers. It is important to understand the differences between the types of moving averages and how to tailor the time period to best fit the trend being followed in order to gain the maximum benefit from this indicator. Thank you for watching this tutorial on moving averages.
Let's go back to Weeble. One of you guys had a question asking why I use EMMA and the length 5, 10, and 20. So I have decided to specialize in day trading and swing trading. So as with something that aggressive, you definitely need to use an indicator that's going to be very reactive, or a moving average that's going to be very reactive to the price changes. If you're a long-term investor, you're going to want kind of the opposite, where the moving averages are going to be more relaxed and not providing as many buying and selling signals, because for a long-term investor, if you have a lot of buying and selling signals to a long-term investor, that could be considered a false signal to them because they're not in it to be that active. You know, they want to hold for the long term. So if we're looking at Facebook right here, we can see that there's definitely quite a bit of buying and selling signals. So if we change that, we got to click on the little gearbox there to get access to that. That way we can change the style. Let's go from let's go the 1 month, month and a half, and 3 months. So you can now see where throughout this time there is no buying or selling signals. It had a buying signal right down here when Facebook was around $267 back in March, and then throughout the summer and fall it has trended upwards, but just recently provided a sell signal again. So but now we're just kind of waiting to see, is it going to provide a buy signal, because we can see that the price line has kind of swooped down a little bit and it's starting to kind of come up a little bit, and the moving average lines or the price line is barely kind of up above all three moving average lines. It's down now, but you know, that's just part of the process. And but we could soon see that this could cross over and provide a buying signal as it's trending upwards, you know, for somebody that's, you know, wanting to hold short term or long term or whatnot. So that's how you can really configure this exactly the way that you need it for your strategy. And so but you know, again, I'm more doing day trading and stuff, so I have to shorten that up a little bit because I have to be very, very reactive. And so if I go to a 1 minute chart, we can see with Facebook, or not so much Facebook, but Apple is very, very commonly used to day trade. So that is always kind of the default number one day trading stock is Apple. So but we can see that after opening, it provided a sell signal, or if you're in the stock options, a sell signal can be a signal to buy a put, where a put is betting against the stock, betting that it goes down, and if it does go down, you're going to gain tremendously. And so that is basically your buying signal to buy a put, or if you're holding, to sell, get out, because otherwise the stock price is going to go down. And as it begins to go down throughout the day, we're just kind of waiting for that uptrend indication, and it almost provided it right here, but not yet. But we have to kind of listen and wait for these signals. Now, even if you did buy a put there and sold there, you gained a lot. That's going from 159 down to 158. You're gaining $100 per contract. And that was probably that could have been like a 40% gain. And so that's huge, and just by listening to that. But if you continued to hold, you would hold until it did provide you a solid signal. And so that's where the price line completely goes through all three moving average lines, and the moving average lines crosses over each other. That's your last and final signal there, and letting you know that it's definitely going to keep going that direction until it provides you a different signal, just like it did here. Now the price line goes down, and letting you know that it's going the other direction. And so these are just a lot of good signals you got to look for. Now you can also change, just depends on what you're looking at, but you can change the timing. It doesn't always have to be the 1 minute. You can go with the 5 minute chart, which actually, if you're just using the Robinhood application, it defaults to the 5 minutes, and it's a very simple basic graph. And that's why I recommend using a combination of platforms. Like I use Robinhood and Weeble. Both are a phenomenal program to use. It's like using two hands, rather than using one with something. You're not as productive. But yeah, look at Apple, how it really changed just by switching over to the 5 minute chart and kind of zooming in. You can see how much cleaner that it is. And so and so that's why you always want to kind of look at both, maybe either at the same time or one or the other. But definitely watch for these signals. Very, very, very important. And that's why I use Emma, as well as the 5, 10, and the 20 minute, or the 20 length number for that setting. Anybody have any questions regarding that? Does everything make sense so far before we move into patterns? And again, I will share a lot of these videos and information with you here in the chat rooms here in just a little bit. Did you have a question? Anybody?
Hey, Carlos, sorry, I have a question. What kind of platform is good for the day trading?
Robinhood is very... even though Robinhood is a very basic platform, it's very user-friendly, but it lacks a lot of advanced features. But the neat thing that I like about Robinhood is that it's very easy to create an order and to send it out. And unlike a lot of other advanced platforms, are a little bit more sophisticated. They're a little bit more. There's more settings and stuff. Now you can configure default settings to make it just as easy once you kind of get the hang of it. But But again, I definitely recommend utilizing a couple different programs. Like Weeble could be maybe your long-term stuff, but while you're using the advanced graphs and charts, you can day trade or do short-term stuff on the Robinhood app. So you just kind of have to feel it out and kind of adapt and see what kind of fits your needs and your strategies.
Thank you so much.
Any other questions? Yeah, Sean chat, he did he texted in the chat room saying that he uses both Robinhood and Weeble just because how easy and fast that he can trade on Robinhood along using the charts on the Weeble. So it seems very common. If you start kind of playing around with the two, you'll kind of feel it out. So let's go into patterns. Let me pull that up here really quick because again, not only is mastering moving averages one of the most important things about trading, but also knowing your patterns. Patterns are helps you provide you information of what direction the stock price is most likely going to go. And so this is kind of like my cheat sheet, and it'll be yours. And so I highly recommend looking at it daily because out of sight, out of mind. You know, the more you look at it, the more you're going to memorize everything. I highly recommend memorizing the names of them, as well as the graph patterns and stuff. And eventually, you'll start to kind of imagine a square box around every price line. And you may identify a pattern and then just kind of compare it with this cheat sheet, and you may have exactly identified a certain pattern, like for example the double top pattern. Very, very common, especially if you're day trading. Now you do find these patterns very commonly throughout the day, but you can find them on a day charts. You know, if you're looking at a long term, a pattern could take several weeks or several months to develop, versus a day trading. The double top could be a matter of 15 minutes. The stock market opens, and then the price may come up, whether the market's down or up during that morning. But usually every time when the stock market opens, the price somewhat comes up, and if it does and then comes down, kind of hesitates around this neckline, and then bounces back up at the same point as the first point. Now usually the first point could take about 5 minutes, then the next one could take down the neckline could be another 5 minutes. That's usually 10 minutes, and the next 5 minutes is that second top. So usually from opening to that second top is usually 15 minutes. Then it starts to fall down, starts to hesitate a little bit, and then begins to drop. Well, this is a very bearish pattern, but you'll notice we have a stop, entry, and a target on each one of these. So a stop is your stop loss, or like letting you know that the strategy is invalid. Something is either manipulating the entire stock market, or it's manipulating that particular stock, whether it's news or whatever the case may be. But normally it always goes in towards the direction that it's trying to go. But just in case, the stop is where it's time to abort. And then the entry point is your time to enter, it's time to buy. So you really want to buy anywhere between the entry and your stop loss. But just watch for the moving average signals, letting you know when to buy and when to sell. And so it will provide you that information, but just know that there's a pattern that's being developed. And so once you get in, then the price drops. We're buying a put, we're betting against it, because just like when we were looking at Apple kind of formed the same pattern where it opened up and then it began to drop. Well, we can bet against it by buying a put using options, and as it begins to drop, we can profit tremendously from it within a matter of just a couple minutes. And so, but just because it goes down, it doesn't mean that it's always going to stay in that target range. It could easily bounce back up and form a new algorithm or new pattern that we just have to watch out for. So that's why it's really important that we watch these moving averages. But Sometimes we need to make sure and compare it with another pattern. Maybe it's the head and shoulders pattern where the second point is a little higher than the first point and then dips back down at the neckline, but then the third point is basically at the same first point and then it begins to drop down. So that we just really got to pay close attention to this, and I highly recommend print it out, look at it daily, put it on your wall next to your computer or whatever you got to do, save it on your phone until you have every single one of these memorized, because it'll only be a huge advantage and in your favor. And then we have the bilateral patterns on the bottom, which could be like a 50-50. So how we deal with those situations, well, especially with this symmetrical triangle, which could be very mistaken for the bullish pattern or vice versa. So we have to make sure we're looking at the angles correctly, where the symmetrical triangle, it shoots pretty much straight up, where the bullish pattern doesn't. The bullish pennant pattern kind of gradually kind of comes up and then forms this little zigzag pattern until it gets to the end of the funnel, and then it shoots up. Where the symmetrical triangle shoots straight up and then kind of starts to zigzag, and at the end of the funnel it could go up, it could go down. So at that point we have to wait for it to pick a direction, whether it's up or down. And again, your moving averages will provide you that signal, letting you know which direction that it's going to go, and just kind of go from there. Because if it's going to go down, it's going to keep going down. A lot of times you'll find these in like penny stocks, or maybe stocks that have beat their earnings, and the stock then shoots straight up more than what it would normally, and then it begins to kind of it's trying to kind of stabilize a little bit. But at the end, that's when we got to figure out which direction that it's going to pick. So again, patterns very, very important. But there's one more pattern I need to pull up here for you, because again, this is a very, very common pattern here. Last but not least, this is the dead bouncing cat pattern, and this happens a lot, especially on a daily basis. And it could be price reacts to some kind of news, whether it was news that affects the entire stock market system or that particular stock. And typically it could be bad earnings. Maybe they didn't beat their earnings, or maybe they missed the revenue, or maybe it's a drug company that's been trying to develop some kind of cancer treatment drug, and the U.S. government, the FDA, decided to not approve them to go to the next level, because maybe they only had a 68% success rate in their drug trials. And so and then all of a sudden the price reacts to that and begins to fall, however much it is. Could be 5%, could be 50%, and then all of a sudden it bounces back, and usually this could be within just a few minutes. The price bounces, and then and it doesn't always bounce back up halfway. It could be a little bit, but it'll look like this. Your moving averages will provide a possibly a buying signal, but if this is the actual dead bouncing cat pattern, it will begin to fall. Your moving averages will provide you a sell signal right kind of where you bought it, and then it'll begin to fall. But basically, to try to identify whether this is a dead bouncing cat pattern, is wait for it to go down right here. If the second point gets right down here, it begins to continue to fall, this thing's going to keep going down most likely all day long. I mean, this could be, I've seen these where they're a 10% loser at the end of the day, 20%, 30%, or even more. And so, but again, we can bet against the stock. If it's going to do this all day long, let's buy a put, and then we can take advantage of the situation and profit from it. So again, dead bouncing cat is a very interesting name and a very interesting pattern, but it is something that does happen on a daily basis, and it's good to be aware of. Any questions about patterns?
What is the time duration that you look into this pattern? I mean, is it 15 minutes? Is it an hour, 4 hours, or what is it?
Well, and that's the key thing is trying to identify a pattern in all those, whether it's a 1 minute, the 5 minute, or your daily chart. It just depends on your style too. If you're more of a long-term investor, short-term, you definitely want to look at your daily charts and look for patterns. Let me go back to Weeble. Let's see if we can find something that has a pattern in it using our daily chart here. Let's see. Tesla, any patterns here? Okay. Tesla may have a pattern here. So here's Tesla. Tesla kind of comes up a little bit gradually, kind of comes down. This could be a bullish pennant pattern, or it could be, let's see here, what else could it be? It could be the falling wedge. So whether it's the bullish pennant or the falling wedge, they both kind of have the same characteristics. It is a bullish pattern. And so as long as it keeps forming this pattern, this little zigzag pattern, whether it's going straight or slightly downwards a little bit, this is a bullish pattern where it will shoot back up past the highest point. So this thing could easily go over the $1,200 again. And so and that's how we can identify that pattern, even though we're watching the MACD do its thing. We're watching the price line do its thing. But we are aware of the pattern, and that it could take several more days or maybe a couple more weeks for it to get to the end of that little pattern where it will react and then shoot back up. And so that's Tesla. Let's see if there's anything else. Good. But again, yeah, you can look at 1 minute charts. There's all different kinds of things. It's just a matter of trying to identify a pattern in something. Let's see, there, Boeing took a big drop. Let's see, AMD. Don't see a pattern there. But again, you will identify patterns more commonly in like a 1 minute and 5 minute charts more than anything.
Okay, and what is the best? When is the best time to? I know there are certain timelines that morning 9:30 to 10:30 is the best time that people invest, and sometime in the afternoon and sometime in the evening. So which is the what is the best time that we can look into this pattern, and what is the best time you can invest, or say for a day trading?
So yeah, definitely good question. And so the most active times of the day is always going to be the first hour after opening and the last hour before close. And so and that's where we can see maybe certain patterns. Like for Apple here, this is the first hour from opening. And so we can see kind of like that head and shoulders pattern that we were just kind of looking at, where we kind of see that first point right here, then the second point, which is higher than the first point, and then it goes down and then it creates a third point, which is just about exactly the same point as the first one. And so that's our head and shoulders pattern, which is a bearish pattern, letting us know that it's going to go down. Plus the MACD is now letting us know that this thing's going to go down. And then the moving averages provides us that it's going down. So we have three basically signals. We had the pattern, we had the MACD, and then we had the moving average and crossovers and stuff provide us all these signals within a matter of minutes, letting us know that it's going down. And so that's where we would want to try to take advantage of it, buy a put, and then ride that wave all the way down, profit from it, and then sell, and then secure your profits, and then repeat the process every day. And you can do it in the morning as well as before close. But Friday was just kind of a very interesting day. So, but normally early in the morning is when we can see some pretty good patterns.
Yeah, that's a good information.
So I'll share the patterns here with you here in just a little bit. But so again, those two things that we've talked about moving averages, patterns, very, very important that we have to master, because it's all part of the system. But we need to eventually, whether you're new or been doing this for a while, we're all slowly developing a set of rules. Every investor and trader must have a strict set of rules that they must never break, because rules help us maintain our risk levels, but also consistency. And so, but we don't always know what these rules are. Sometimes we may change them as we're trying to learn from our mistakes or learn from others. So I'm going to pull up just kind of a list of some rules that we can use as an example. Now, these rules are day trading rules that we're just going to use as an example, but they have some similarities to other types of investors, like long-term and short-term. So rule number one: always have some kind of limit for volume. In this example, 1 million should be or more should be your limit. Don't trade a stock that only has 100,000 or 200,000 in daily average volume. Same thing with options. Have some kind of limit on some kind of options volume. It's got to have at least 10,000 in volume or something. As well as a price limit. Always have some kind of limit. Like my personal limit on a share has got to be at least $5 or more. Usually if it's less than that, it's struggling for some reason, especially if it's under $1. Not only is it struggling, but they are in violation of a lot of rules and regulations, even though they still may be on the stock market, but they're at jeopardy of getting delisted. And so if they get delisted, the value is going to depreciate like 50% every single day, and you won't have any option to buy anymore. You just have the option to hold until it disintegrates, or you can sell at a significant loss. And so if a stock is under $1, they can do what's called a reverse split, which they merge a bunch of shares into one, kind of fluffing their numbers up a little bit, but that's only buying them time. Time for them to figure out what they need to do to their company, so that way they can become more profitable and to appreciate their share values. Most of the time, when they're down there, they're down there until they go bankrupt and they get delisted. So just avoid, have some kind of certain price limit set for yourself, especially on stock options. $30 or more, that's a good one for options. Or percentage change, that kind of goes with the moving averages as well. As we're trying to look for a change in the graphs, we're looking for a change within a certain time, and that way it's letting us know what direction that it's beginning to go. And so rule number 2, day trade only, no swing trading. The reason why that is a rule on this example is because day traders like to get in and out. When they identify a pattern or moving average, they can get in and out. They're not holding overnight because they don't always know exactly what the next day is going to be like. The next day could be very bearish, it could be very bullish. But rather than risking that or going into the unknown, is they'll just wait and see, and then plan their attack accordingly to what the market is doing. And so, and that's why there's no swing trading. Now, I have really, again, mastered all kinds of stuff. I've mastered penny stocks. I've mastered, everything, and basically, I've really adapted to options, and I do what's called straddling, where you can buy a call and a put, where you bet a stock goes up and you can bet against the stock, betting the stock goes down. So that could be very, very effective for swing trading, and especially if the market's going to be volatile, very volatile. Now, we'll get into options more here in just a little bit, but I always tell everybody that you can only lose what you put into one side, but your gains on the other side are potentially unlimited. So if you lose, let's say 90% on a call and the market goes down, because the market goes down, your put may have gone up 300%. That means that 300% just washed out that gain of your 90% loss, and it puts you out ahead. So for example, if you put $1,000 on a call, or a bunch of calls, and $1,000 on a bunch of puts, and the market tanks the next day, and you lose 90% of your calls, that means you only have $100 left there because you lost $900. But that $1,000 just turned into several thousands of dollars. So you basically gain 50% of that overall investment strategy. And so that's why I straddle, which we'll get more into that here in a little bit. So, but each rule is just to each their own. It just depends on what type of investor that you are. So rule number 3: trade stocks with news, press release, etc. It could be hype, whatever's just creating a lot of volume and volatility. Volatility is one of our key ingredients for success. And so, which leads into rule number 4: volume of the day, or high market cap companies like Apple and Facebook, Tesla and Boeing and whatnot. So these are very smooth moving price reactions. These stocks usually only move 1, 2, 3% a day, versus a penny stock can move 10, 20, 30% a day. So it can be a lot, really volatile. It can shoot straight up, you can shoot straight down. But as we were looking at the charts with Apple, it was very gradual. It's very smooth. We can really identify the signals much easier and much safer. And so rule number 5: enter at midpoint of support and resistance. That's basically our moving averages. Buy when it provides us the signal to buy, and sell when it provides us the signal to sell. Rule number 6: always do a limit buy and a limit sell. Now, when you're doing options, it automatically defaults to that. But when you're buying shares or selling shares, it will typically go off of a market buy and a market sell. Now, the difference between the two is that the market buy will buy immediately, but it will buy at any price, even if it's at a higher price than you anticipated, which is not in your favor. If you do a market sell, you're telling the system to sell at any price, even if it's at a lower price than you anticipated. But if you do a limit buy, you're telling the system to buy at your particular price or lower, whichever is in your favor. If you do a limit sell, you're telling the system to sell at that particular price or higher, whichever is in your favor. Now, the disadvantage to that is that as you're starting to type in your settings and to send out the order, the price may have already passed that. And by the time your order gets sent out, it might not execute because now it's already past that. And so you may be sitting there and it may or may not ever execute. So then you have to go back in there, you got to cancel it, you have to modify it or replace it. Now, to try to avoid that, if you do a limit buy, try to set the price maybe a couple pennies higher, just in case by the time you send the order out, that you're already kind of adjusting for the price difference between the time it took you to send the order out, because it could take a couple seconds. It could have taken you 5 seconds, could have taken you 10 seconds, maybe you got distracted, it took you 20 seconds to put in your price and all that stuff and to send the order out. Well, the price is not waiting on you, it's still moving in the back. And so but if you put a couple pennies higher on your limit price, then it can help that out, and that way you're not having to go back in there, replace or modify the order. Same thing with the selling price. If you do a sell limit price, put the price down a couple pennies less, just in case. That way we'll try to get the order to execute more effectively and immediately. Rule number 7: ABCD pattern. Try to always enter at the C point. So I'm going to switch over to another image that'll show you what the ABCD pattern looks like, or what it kind of means overall. Let's see here. So ABCD pattern is right here. So the ABCD pattern, so basically when the stock market opens, the stock price breaks out and sets an intraday high level. So usually between when the stock market opens and to the A point is usually about 15 minutes. As we were talking about the patterns previously, it took about 15 minutes for between opening and for it to reach the top, and it may provide certain patterns or signals or whatnot. But then after 15 minutes, the price begins to pull back and sets an intraday low point. So that's the B point. So between opening and here is usually about 30 minutes or so. And so within the next 15 or 30 minutes, the stock sets a higher low and begins to turn. And that's at the C point. And then we can see where it's providing us a buying signal or a selling signal using moving averages. That way we can adapt to that and take advantage, because at that point usually the stock price is going to either keep going up or it's going to keep going down for a majority of the day. And so it's also telling us that it recommends to wait after at least the hour, because again, the first hour and the last hour of the day are the most volatile. That's the most active times of the day. Now we can still trade within that point. You just got to be very, very careful. But to reduce the amount of risk, it says to enter at the C point. Wait between 45 minutes or 1 hour, sometimes an hour and 15 minutes, but it's usually within 1 hour, to see what the direction that the stock price is going to go. And so just avoid all that volatility and go for the majority. And so that's what that rule means if you're trying to reduce the amount of risk. Is rule number 7, ABCD pattern, enter at the C point. Now rule number 8 says sell 50% of your position at a target goal. Now that's not really a rule for day traders, because a day trader will get in and they'll get completely out. And so, but I will find this for a lot of long-term investors. Well, they'll invest a certain amount into a stock, and then once it gets to a certain point where they've gotten a lot of gains, they'll sell a certain amount, which the original dollar amount that they put in, they'll get out. That way, whatever is left over, they feel is like free money. So that way, it's just sitting there, it's free money, and then they'll take that money out and maybe reinvest into something else. And so that's usually a rule we'll find with a lot of long-term investors. Rule number 9 says beware of the false breakouts, sell right below the support level. Now we talked about the false breakouts, and that's why we need to configure your moving averages accordingly to your style in investing and trading. So that way you're not getting a lot of buying and selling signals, and that way you can get something that's a little more effective. So rule number 10, cut losses. Basically always have some kind of stop loss. Don't buy and hold and hope for the best. Cut losses at a certain point, whether you're down 2%, 5%, 10%, something is better than nothing. Ride winners at least 10% or more, until it provides you your time to sell. And so these are very, very good, important rules that we can use as an example. But then it leads us to the next thing, is the difference between an amateur trader and a professional trader. Let me pull that up here for you, because this all kind of ties in together. So this is the differences between an amateur and a professional way of thinking. And so again, it's very important, because this is like the difference between right and wrong. And so, and you don't know the difference between right and wrong unless either you've experienced it or you're taught by somebody that knows. And so where an amateur trader will let losers run and hope they turn around. And there's that key word, hope, because they're using the hope system. They're throwing money at something, hoping that it sticks, and they wish for the best, because they don't have a structure. They don't have a system that they're using. Maybe they're just using the Robinhood app and nothing else. And so that's not going to work. Where professional traders will cut losers when a stop is reached and a trade idea is invalid, because we have a system in place that provides us when to buy and when to sell. Where an amateur trader will close winners too early because of fear of giving back profits. Maybe they were, beat up a little bit on some stocks and they lost a lot of money. They're trying a different stock, see how that goes, and then it goes in their favor, and they decide to sell, and they sell too early, and it just keeps going. And especially if it's providing them that bullish pennant pattern, which can easily confuse a lot of new traders, whereas the price is kind of hesitating, but it's creating that funnel, but it's letting you know it's going to get ready to go up again. And then they end up selling, and then it goes up, and they're like, oh man, I should have held. Why did I sell? Blah, blah, blah. They weren't listening to because they didn't know. They didn't have a system in place. Where a professional traders will let winners run until a profit order or when a clear signs are given to exit. Trust their system. The system is moving averages and patterns. Amateur traders will trade or change their trading system after a few losing trades, because they think that whatever they were doing was working, and now that it doesn't. Well, keep in mind, whether you're been doing this for a long time or just started trading, there are certain characteristics the stock market has throughout every season of the year, and what it does, it reloops itself over and over and over. So we have a yearly cycle, and we have like a 10-year cycle. Now the 10-year cycle is a little more catastrophic. That's where we have like the housing crash and the automotive bailouts, and then we have this pandemic or whatnot. Every 10 years it's that, but every year it's something kind of minor. Where they, and basically with these algorithms, the politicians and investors will kind of pour fuel on the fire, just like what just happened last Friday. They made this very, very minor situation into a very catastrophic news, made the stock market tank. Well, we're on the verge of a correction anyways. We're going into the bearish season. So what better way just to make the situation worse by pouring some negative bearish news in there, and so it's just really important to be aware of everything, including the seasons. That way you can adapt strategies to every single season, whether it's a bearish season or a bullish season. Where professional traders will stick to their rules religiously and think process oriented. We talked about the moving averages and the patterns. That's the process. We talked about the rules. That's got to be that you got to stick to those religiously, no matter what rules you have set for yourself. You must never break them. An amateur trader will close their trades, never look at them, and avoid a learning effect. And a lot of times you'll see them post on social media, hey, I got $1,000, what should I put it on? And they'll get a big random amount of information. Well, there's nothing really wrong with that, but eventually it's time to become a independent, successful investor and trader, where you don't need anybody but yourselves and a phone or a computer. And where a professional trader will analyze their past performance, keep a trading journal, and learn from their past behaviors, but also to learn from other people's mistakes. That way you don't make the same mistakes. Amateur traders will often overtrade, revenge trade, and hope to make a lot of money fast. Now, there's nothing wrong with making a lot of money fast. We just got to do it the right way, but also we got to keep our emotions out, because revenge trade is because your emotions have affected your buying and selling decisions. And if you're emotional, it's time to pause, to step out, whatever you got to do, because emotions cannot be a part of this. We have to think analytically, statistically, and strategically, like some kind of robot. Where professional traders are aware of their emotional impacts and know how to identify and manage their impulsive buying and selling decisions. An amateur trader will open their trading platform and then desperately try to find random trade entries, where a professional trader will keep a trading plan and plan their trading day ahead, follow a structured approach. And Benjamin Franklin once said, if you fail to plan, you're planning to fail. So we always have to plan ahead. And by doing that, we have to know what each day of this week is going to be like, which leads us into the next phase of this training. But before we do that, does anybody have any questions about anything that we've been talking about so far?
Hey, this is Raj again. So, when you talk about the volume, is there something called bearish volume, bullish volume, and where will I get the information? If I go to Barchart and there is a volume information, but is there somewhere? I know the Weeble has they have the pie chart showing so many inflow, so many outflow, but is there really some place that I can get a bifurcation of how much is selling, how much is buying, and all that stuff?
Yeah. Now, as we look at this is the what are we on? We're on the 1 minute chart on Apple using Weeble, and so the volume bars are right down here on the bottom. So again, the red means that it's a majority of selling. Green means it's the majority of buying. And then the length of it represents the amount of volume for that particular time or day. Now, on the very top of the graph here will now show you that information of that particular time. So within this of opening on Apple on that 1 minute had over here where it says 20 or basically 2.7 million, and it's green, which means it was the majority of buying activity. And so, but if you go down, you can kind of see, the same thing at this time. We have about 683,000 in mostly selling activity. And then if we change it to our daily chart, we can see the same thing. That way we can see, what's kind of going on for each day. So this was Friday, that was Thursday, that was Wednesday, there was no Thursday. So that was Wednesday, that was Tuesday, and then Monday looks like it was a majority of selling activities. So that's where you can kind of see, kind of what people are doing at each particular day. And that way you can kind of have a little idea of what's going on. But this is kind of where you would go to kind of study that information.
Okay, thank you so much. And what type of chart is very? There is the candle chart and this line chart, and which is so realistic?
Well, again, I prefer to use the lines because I need clarity. I need to be able to see exactly what's going on and when it's doing it, versus the candles. I mean, you can kind of see it, but it's still questionable, but you can kind of see that, the volume. You can you see green, red. It's basically duplicating itself. So we don't really need to have that. So I picked the clarity over the candle information, because it basically kind of shows you the same information, so we don't need to repeat ourselves. So I think the clearest picture would look like this.
Okay.
Any other questions anybody have with everything that we've talked about so far before we go into planning our week ahead? So Sean asked about the dead bouncing cat pattern, if that would apply to cryptocurrency, especially with the Dogecoin. Dead bouncing cat. I really don't see on the daily chart. I mean, it's with crypto, it's a little different, but it can. But I don't see a dead bouncing cat. Let's go to maybe a 5-minute chart. No, I really don't think I see a dead bouncing cat on Dogecoin. So I think we're okay there. Dogecoin. But cryptocurrency is usually very active during the winter time. So basically, I see this dip with cryptocurrency, across the system as being manipulated. Most likely it's being manipulated by China or other countries, and they do it intentionally. That way they can buy in low, because it's going to go right back up, especially right before the winter time. As the winter time is the most bearish time for the stock market, we get a lot of investors that'll pull out and they'll park the money in cryptocurrency. Well, that creates a cryptocurrency to appreciate, and then cryptocurrency goes up. And so, and then vice versa, where cryptocurrency usually goes down during the summertime, and the stock market goes up, because then people pull their money out of crypto, and they start pumping up the stock market from that. So, with the dips that we've seen with cryptocurrency, it's like a Black Friday sales event. So we got to, there's certain things that professionals have been saying for a long time, and one of them is buy the fear, sell the greed. When stocks go down, that's a great buying opportunity. We just got to wait for the right time. Got to wait for the right buying opportunity, because by looking at a Dogecoin's daily chart, we're waiting, because it's downtrending. I mean, it provided us a sell signal quite a while ago. It's downtrending. We're waiting for a buy signal. When is it going to do that? Not sure, but we just have to be patient and wait for that signal, because when it happens, it's going to keep going. It's going to keep going up. And so we're just not sure how long or how far it's going to go up until it provides us the signal. So this is our assistant. It's working for you for free. You just got to set it up. You just got to have to learn to communicate with it. And just like any other person, or learning a new language or sign language, you just have to learn to communicate with it, because communication is key. So let's move on to the next thing of planning our week ahead. So, and for many years, I never really understood how the market fluctuates, and over years, I've learned that it's being manipulated, but also I've learned that the economic reports have a huge impact on the entire stock market system. So if the economic reports have the biggest impact on the entire stock market system, it only makes sense that is something else that we all have to master. Because if you have seen a lot of my text messages in the last couple of weeks throughout the in our chat rooms, you have seen where I'll post like a volatility alert or something, because I know it's going to be reacting to that event within the next hour. So rather than not knowing, and then you're like, and then you see that something is different, whether it's good or bad, and then you're like, well, what's going on? Why is it acting this way and whatnot? Well, we could have known way ahead of time, a week ago or whatever. And so I'm going to switch things here. Give me a moment here. So the best website and application to use for economic reports, and I've tried many of them, but investing.com seems to be one of the best websites. I mean, it's very sophisticated. It's kind of cluttered, but we just have to learn to kind of use it. Now, it's an app you can download in your app store, but it's also a website you can go to. If you're using the app, it's a calendar icon on the bottom middle area of your screen. But if you're on the website, it should be on the top area. It says economic calendar. So we'll want to click on that. And we'll want to click on filters, because again, there's going to be a lot of gibberish. We need to get rid of a lot of this stuff. So we click on filters, and what we want to do is we want to click on clear, because we want to clear everything. There's only two things that need to be selected. And the first one is the United States, because we need to see everything regarding the United States. And then under importance, we have 1 star, 2 stars, and 3 stars. We want to put a check mark under 3 stars, because now we're telling this system that we want to see everything that'll have the biggest impact in the United States stock market. So once you have those two things selected, we want to click apply. And then we can click on this week. That way we can see everything that's scheduled to happen this week that'll have the biggest impact on our entire stock market system. Unlike earnings or other things that can have effect on certain segments of the stock market, this has an effect on the entire stock market system, every single stock. So when we're looking at it on the website for the times is going to be based off Eastern time, where Wall Street's at. If you're looking at on your phone or tablet, the time is going to be based off of your time zone. So you have to be aware of when the stock market opens and all this stuff. And so that's critical. Time is very sensitive. Now, when you get this information from here, because this information comes out immediately, you're getting it at the same time the news companies are getting it, whether it be Fox, CNN, Bloomberg, Yahoo Finance, whatever. They're getting it as soon as you're getting it. Now, it takes them time to process stuff, to create an article or talk about it on their television or whatever. But while they're doing that, you already know about it. And so then within minutes or within the hour, you're getting news alerts on it. And so that's part of one of those old professional sayings that, or professional trader sayings that say, buy on rumors, sell on news. The idea is to own whatever it is before it gets on the news, because if it's on the news, it's too late or you're left money on the table. So the timing of this is very, very critical. So, but also looking at this daily is very critical. Also looking at it on the weekends. Now, the reason why I mentioned looking at this daily is because then you'll actually have the actual, results that'll be posted, but also the government or somebody may have thrown in an unexpected meeting or some kind of report. So that's why we want to look at this regularly, because things could be added or changed. Plus, we'll know what's normal and what's not normal as we look at this, on a daily basis. I've been looking at this stuff here for a couple of years now, so I know what's normal and what's not normal. But so again, for like Monday, now normally there is no economic reports on a Monday, but for some reason there is a bunch of things going on Monday, and this week seems to be very, very busy, which means this week is going to be very, very volatile. So we got Monday, Tuesday, Wednesday, Thursday, Friday. There is no slowing down this week. This week is going to be crazy. And so, but with this time now, the stock market in Eastern time, where Wall Street's at, opens up at 9:30 in the morning. And so this basically is letting us know that the federal chair, Jerome Powell, is going to start talking 30 minutes after the stock market opens. So pre-market is going to be kind of weird. It's going to be a little hesitant. We might not see a lot of volume during pre-market. So pre-market could be bearish. I hope it's bullish, but we'll see what happens. But overall, I think the volume is going to be very, very low until this guy starts talking. Investors are going to start watching. But again, that goes down to that whole ABCD pattern, buy at the C point. When he starts talking, that's where the C point is. Because remember when we were talking about the C point is usually 45 minutes after the market opens, or an hour and a half. These guys are very smart. These are no dummies. They plan things accordingly to this entire system. So the more the more advantage that you have. So that's where we got to wait to see how he will affect the entire stock market system. Now, normally when he talks, before he talks, it's usually we start seeing bearish characteristics, but after he talks, usually he kind of saves the day a little bit, and it provides bullish characteristics. So that's kind of what my feeling is, that we may feel a little bearish characteristics beforehand, and then bullish characteristics after that. But at the same time, we're going to have some mixed signals as well with this pending home sales month over month, with home sales that are, still, kind of in the process. Again, just like our last meeting, as I had mentioned about the pre-existing home sales and new home sales, how they set the bar low. The bar was set low. I had mentioned that the government wants to start increasing interest rates. People are going to either refinance their homes, they're going to buy their homes before the year is over, as well as vehicles. And so so this is going to create a little surge in home sales. And so where the previous report for September was down a little bit, it was down negative 2.3%, but the government forecast that this next report on tomorrow morning is going to be at 1%. In actuality, we could see this at 2% or 2.5%, maybe even a little bit more. And so I think this is going to be a bullish characteristic. So, and then we have the FOMC member Powell speaks again later on in the evening. This is usually where they could start talking about inflation, interest rates, things like that, which usually investors don't usually like to hear. So, so this is gonna be a very volatile day. So it looks like to me, around opening, we could see some bearish characteristics, then go bullish, and then towards the end of the day, we could go bearish again. And so we could be in the red a little bit. It just depends. We'll have to really wait and see how this affects the stock market. So we have to plan accordingly to that, but also watch the moving averages and our patterns. And then going into Tuesday, we have the consumer confidence report for the month of November. Now, if you're not sure what these are, you can click on them. It will open up a new tab or provide you a little tiny paragraph of what it is and how it will affect the stock market. So for example, the Confidence Board, or CB, Consumer Confidence, measures the level of consumer confidence in the economic activity. It is a leading indicator as it can predict consumer spending, which plays a major role in overall economic activity. Higher readings point to higher consumer optimism. A higher than expected reading should be taken as a positive or bullish for the US dollar or the stock market, while a lower than expected reading should be taken as a negative or bearish for the US dollar or the stock market. Now, some economic reports, we need the numbers to be down, like oil inventory levels or unemployment levels. But most economic reports, we need the numbers to be higher. And so, but it will tell you right there what it is and how it can affect the stock market. So with the previous report of October, it was around 13.8, and where the next report is forecast to be around 110.9, and so that could easily provide some bearish characteristics as the number becomes lower and lower month over month. That's and again, that is going to be a report 30 minutes after the stock market opens. So a lot of times, if investors in Wall Street know that this report is going to be negative anyways, that we're going to see more low volume and more bearish characteristics. And so with the federal chair Jerome Powell testifies again, it's going to create more volatility. We see a time, there's no time, it says tentative. And so that is where we need to revisit this section every day to see any kind of changes or if there's been anything that's been added. And then going into Wednesday, we have the ADP non-farm employment change for this month. This will be reported well before the stock market opens, about an hour and 15 minutes before. So this report will easily can affect the pre-market, make pre-market a little more extra volatile compared to maybe some of these other previous days. So, but the previous report of October was reported at 571,000, where the forecast that this report could be a little less at around 525,000. Now, if you look at this regularly, we've noticed that like last report was a phenomenal record-breaking 199,000 reported for unemployment last week since the pandemic started and we had the shutdown. This has been the lowest number, and so it just kind of feeds into this other non-farm employment change. So basically, this is, I think that the government has the bar set low, because I feel that the report is actually going to be much higher. It'll meet or possibly beat the previous report, because things, when it comes to employment, things are a lot better than before, as well as we're getting closer and closer to the holidays. More people are looking for work, extra income, but also you have the other issue where the government has reduced the unemployment benefits altogether. So I feel that the government definitely has set the bar low. So I feel Wednesday we could see a lot of bullish characteristics. So We could see a Wednesday morning could easily be in the green. And then at 10 o'clock Eastern time, 30 minutes after the stock market opens, we have the Federal Chair Jerome Powell testifies again. He's going to be all over the news this coming week. And then at the same time, we have the ISM manufacturing for the month of November is also going to be reported. It looks like it's going to be around the same report as last month. So most likely that probably won't have as big of a reaction as the Jerome Powell testifies. But crude oil inventories, after he's done testifying at 10:30, 1 hour after the stock market opens, that's when the crude oil inventory levels will be reported, where the previous report last week was actually up 1.01 million barrels, but they anticipate that'll be a little lower, especially throughout the holidays, Thanksgiving. I mean, a lot of people did a lot of traveling, a lot of driving, so most likely the bar is set low on here, and it's going to be even it's going to be more in our favor. So I feel that we're going to see a lot of bullish characteristics on Wednesday compared to the Monday and Tuesday. And then Thursday is going to be a little bit more of a mellower day with just the unemployment report that comes out 1 hour before the stock market opens. The previous report for last week was 199,000, which was very, very low. That was a massive drop. But normally when we have a massive drop like that, it'll bounce back. So, but it might not bounce back that high. So in a way, I think they may have set the bar low on this, because if it bounces back, it'll probably be at like 220, 225-ish is my guess. So, but that's going to be, I think we're going to see more bullish characteristics with that report coming out. So again, Monday, Tuesday is going to be very volatile. There's a lot of questions, uncertainties. So I definitely see a lot of bearish characteristics for those days, but Wednesday, Thursdays looks pretty bullish. And then going into Friday, we have a couple economic reports that are released 1 hour before the stock market opens. Our non-farm payroll for the month of November looks like the previous report was about 531, where the forecast will be about 550. I think this number is going to come back a little better. As well as the unemployment rate is going to come back a little better, and so Friday we could see some more bullish characteristics. But going into the weekend, we'll really have to pay attention to the news and any little curveballs that the government may throw in, especially as they talk more about this new variant strain of COVID. They're going to do whatever they can to and whenever they want to manipulate the stock market, and that's what this is about. Is just creating volatility. Stocks are really high right now, and they need to come down. So I mean, we are on the verge of a correction. We're going into the winter time, and so we're going to see this transition of bullish characteristics into bearish characteristics, and we're in the middle of that transition right now, which is normal. The fall is that transition, and it does that year after year. So it's perfectly normal, no matter what they say in the media. So this is what has the biggest impact in the stock market as we start to plan ahead. And we could go even a little further if you wanted to go in the next following week, but you can see that there's only 2 reports that are scheduled. But if we look at this regularly, we'll see that more and more are added. So that's why we want to look at this every single day, no matter what. And so the next thing that'll have another impact on the stock market is going to be the earning reports, but it's not going to affect the entire stock market. It'll affect usually segments of the stock market. So, and that's where every Saturday, if we go to our group in our featured area or announcement section, I always post this week's scheduled release earnings. And that way you can see, what are going to be released, before opening as well as after close each day of the week. but also the top 10 is also right here in the description. So the first one, the most anticipated release earning this week is going to be Li Auto. I mean, they're another all-electric company, or automotive company out in China, next to NIO and a couple of those other guys. And so they're going to be released tomorrow morning before the stock market opens. The next one is going to be Salesforce, then CrowdStrike, DocuSign, which DocuSign is a pandemic stock. Then we have Snowflake. Then we have this artificial intelligence company called C3, which is very interesting. Then the Dollar General, Marvel makes microchips. There's a shortage on microchips, so there's going to be a lot of people watching these very closely this week. And so throughout Saturday, I'll also post the top 10s analysis in here, so that way we can always look to see not only when they're going to report their earnings. Looks like Monday, so that's tomorrow morning at 5 in the morning. But the company basically has a 72% expecting an earnings beat. Now this is very, very accurate. And when we look at this regularly, you'll notice that around 65 or 68% is about average. Anything more than that is considered above average. Anything below that's considered below average. So, but at 72% expecting an earnings beat is definitely considered above average. And when you look at it in odds, in a sort of way, you basically have 3 out of 4 odds that this stock is going to beat their earnings, and the stock's going to go up. And then when we look at Salesforce, again, we'll show you here where the day and time when the earnings are going to be released. And here, using these little indications here that the company's release has a 67% expecting an earnings beat. So those odds, not so good. Basically have a 2 out of 3 odds that the company's going to beat their earnings and the stock's going to go up. Then we have CrowdStrike, which they are scheduled to release their earnings Wednesday after close. The company's earning release has a 75% expecting an earnings beat, which is very, very good. Then DocuSign, again, which is a pandemic stock, which if you're not familiar with that, they're the little e-sign digital signature things for mortgage companies or dealerships and whatnot, or many other companies. A lot of banks use them, auto insurance companies and whatnot. But DocuSign is scheduled to release their earnings Thursday after close. The company's earning release has a 76% expecting an earnings beat, which is very, very good. It's very high and definitely considered above average. Snowflake is scheduled to release their earnings Wednesday after close. The company's earning release has a 75% expecting an earnings beat, which is very good. This is the artificial intelligence company called C3. They are scheduled to release their earnings Wednesday after close. The company's earnings release has a 54% expecting an earnings beat. Out of the top 10, this has probably one of the lowest percentage odds that they're going to beat their earnings. So that's not good. Dollar General has been really expanding their store. They got a lot more stores this year, and so it's going to be a very interesting report. But the Dollar General is scheduled to release their earnings report Thursday morning before the stock market opens. The company earning release has a 71% expecting an earnings beat. Then we go on to Marvel Technology. Marvel Technology is scheduled to release their earnings report Thursday after close. The company earning release has a 82% expecting an earnings beat. Out of every single earnings report or that's scheduled to be reported this week, this has the highest percentage chance that they're going to beat their earnings. Again, there's a microchip shortage. So these guys are working around the clock 24/7 trying to produce as many microchips to help with this shortage. And so that's only going to help their revenue. It's going to help their growth. And 82%, again, if we convert that into odds, that's a 4 out of 5 odds that this company is going to beat their earnings and the stock is going to go up. So, but again, this is a lot of news companies and investors are going to have their eyes on this guy. And again, the old saying, buy on rumor, sell on news. This thing is going to make some big news. Then we have the little Z-scaler. They are scheduled to report their earnings Tuesday after close. The company's earnings has a 58% expecting an earnings beat, which is not good and considered below average. Then we have this one here. They are scheduled to release their earnings Thursday after close. The company's earnings release has a 77% expecting an earnings beat. Now, a lot of times I'll put, images on here with certain clues, so that way you know that they're associated with other companies or products or services. That way you are aware of not just the company name, but maybe a little bit more info and clues and tips from the image. But by looking at Marvel Technologies, you might not know that it's a microchip company or Dollar General or this artificial intelligence or the C3. They help make artificial intelligence software for robots and whatnot. And so again, some of these will have a big impact on those parts of the segment of the stock market. So it's just very, very wise to know both your economic reports and your earnings reports and what's scheduled to happen. Because when there's something that's scheduled to happen, that's going to create a lot of volatility, because Wall Street knows about the schedule. All the investors know, the professional traders and investors, they all know. So you have to know just as they do. And this is the best way, the simplest way, user-friendly to collect all that information, rather than diving more into more sophisticated things in other websites, especially if it's premium websites where you're having to pay a lot of money for this information. There's no reason to pay for this type of resources when you can get it all right here. So hopefully that all makes sense, and that'll lead us into activity. Let's take a look at some activity with options. And options is a really key thing because options helps us make a lot of money, and a lot of money fast. I'm going to see if I could show you something here really quick. I'm going to switch over to Weeble. Let's see what was really volatile. Let's see, Apple. Where was Apple? Apple's right here. No, hold on here. Let's do Apple. Let's double check some here. Options. It's probably trying to pull data for today. Okay, so I'm going to have to go somewhere else here. Let's go to the website. We're going to go to a NASDAQ website right here, not Peloton. I'm going to pull up Apple here, see if that can show me something here. Okay, so here's Apple. So this is Apple's activity last Friday for options. So again, calls, this is the most active calls for Apple on Friday, and this is the most active puts for Apple last Friday. And so but it's very intelligent information, but it's very important that whether you're into options or not, this really provides you some great intelligent information. Because if you're not into options, you can still use this information to determine what investors are betting that the stock price is going to reach. Because you may see a lot of buying activity on a certain strike price, letting you know that it's most likely going to reach a certain price. And so, but we'll get more into that here in a little bit. But by looking at Apple, we can see that Apple, these calls lost a lot. We had 99% call, was down on that $160 call strike price, which most likely expired last Friday. But we can see a 30% loss, 67% loss, and so on. So, but over here with the puts, we have a 230% gain. There's a 182% gain, 252% gain, 134% gain. That's why I say if you can only lose what you put into one, but you can gain unlimited on the other. And the reason why I straddle on a daily basis is because straddling is where you buy both calls and puts on the same stock. because if I lose 100% on one and gain 200% on the other, I gain 50% altogether. And so if you don't want to know the economic reports or really know what the next day is going to be like, straddling is very, very effective, especially when times are very volatile like they are right now. And so you almost can't lose. The only time where if you lose on straddling is if the stock price isn't going anywhere, and it's stuck at like 0%, or if you're and it's doing that, and it's at and you're suffering from time decay or time depreciation. That time decay will slowly devalue both your calls and puts if that stock isn't going anywhere. So that's where we need volatility. But yeah, whether you put $100 on one and $100 on the other, or $1,000 or $10,000. Let's say you put $10,000 on a bunch of calls and $10,000 on a bunch of puts, and you lose, let's say you lose 75% of that $10,000. That means you lost $7,500, and you still have $2,500 left. Now on your puts, you just gain, let's say, 200%. That $10,000 is now turned into $30,000. Plus, you still have $2,500 left from your calls. And so you're putting that over. So now you have $32,500 left from your initial $20,000 investment. So that is, that's like a 60% gain. And so, and then you just do that regularly every single day. You're gaining 20%, 50%, every day, and then you're gaining 100% or more every week. And so that just accumulates and accumulates, and now you're in some pretty large, money. So that's where, straddling can be very effective. But if you're more certain that the stock market or the stock price is going to go in a certain direction, and that the stock's going to go down, that's where you can gain tremendously very, very quickly. Now, there's another website that we can use called Barchart.com. Barchart.com is free, and it provides a lot of great, highly valuable information. Now we'll talk about the options area, so we'll click on options, and then we have most active options. So this is going to pull information from Friday. Now this information updates regularly when the market is open, so we can use it as our watch list. We can use it for a lot of things. But what this page does, it summarizes the entire options system in one page. So for example, Apple is basically on the top because everything's sorted out by options volume. So again, options volume is buying and selling activity that resets every single day. Now, when we look at this page every day, we normally see what's normally on here and what's not normally on here. When we see like Apple is here every single day, it's because, as well as Tesla, it's because these two are very popular for day trading and swing trading. So they're always on the top of this list. But if we see something that's not normally on here, but now it's on the list, like American Airlines or Pfizer, there's a reason for it, because now there's a lot of activity on it for some reason. And that goes above and beyond what it normally would have. And so that's where it creates unusual activity. We got to, pay very, very close attention, because even if there's no news, that means something's flying under the radar. Something's about to happen and it hasn't happened yet. I've done this even when back earlier this year when GameStop and AMC did their thing. I mean, I saw AMC and GameStop were up here when they were still $5, and then all of a sudden they started to surge like crazy. Well, you can find things that are flying under the radar by looking at this. And so, but with Apple here, Apple typically dominates the top of this list. They were currently at $156.81 a share. They were down $5 for that day, or down 3%, with 1.3 million in volume. But out of this volume, 69% are betting that the stock's going to go up, whether it be later on that day, or most likely it'll be the next day, or the next trading day, where out of that volume, less than 31% are betting against the stock, betting that the stock goes down. So sometimes we can look for not only unusual activity, like Pfizer's is third place on the list, which normally it's not on the list, and now all of a sudden it's third place on the list. It's up, and it's up quite a bit. It's up 6%, and it's only $54, which is still kind of low. We have a lot of options volume, and the call percentage ratio is over 78%. And just like the earnings percentage ratio, which normally averages around 65% ish. Any less than that is kind of below average. Any higher than that is above average. This is way above average. So there's a lot of pieces of the puzzle here showing that this thing could keep going up for this week. And so that's where we just got to really pay close attention. And then we have American Airlines, which is not normally on this list, and now it is because people are, looks like maybe people are straddling it, where it's 50-50. People are biting both the call and a put. And so, and then if it goes down, let's say, so that, almost 9%. Let's see what that 9% did. So we go back to the NASDAQ website. We'll replace the AAPL in the URL code, or you can just go to Google and type in AAL, NASDAQ most active options, or however, works for you. But in this case, I'll just change the code or the ticker in the URL code, and then that would get that here. So we can see that the biggest gain in the puts for American Airlines was 728%. So that is huge. So let's say if you bet $1,000 on calls, $1,000 on puts, you're going to lose a lot on your call, but your gains, that $1,000 could easily turn into $700,000 or $800,000 very, very quickly. And so that's where I think we're seeing a lot of people straddling American Airlines right now, because the volatility is a great ingredient for straddling. Then AMD is normally on this list. It's usually in the middle somewhere. It fluctuates, but these are all great stock options to day trade and to swing trade. So you just kind of pick, as we were looking into the rules, it said to trade high market cap companies, as well as activity, news, hype, things like that. Well, that's these guys. These are kind of our list. This is our watch list. And so then we have Carnival Cruise, same thing. Looks like we have some straddling activity with that one, just like American Airlines. Then we have AMC, which AMC should start getting some interesting activity. In fact, I think AMC may have, I have to check the chart really quick, but there may be a pattern in AMC. I can't remember if there was or not. Let me double check something here. Yeah. So I'm going to switch over. We'll switch over to the Weeble really quick. So AMC, you notice that pattern? This kind of looks like the bullish pattern, a bullish pennant pattern, where the stock price gradually begins to come up, then it kind of comes down a little bit, and it does this little wavy pattern where we're getting close to the end of that pennant, where the stock is intended to go up, unless this is a symmetrical triangle, which I don't really think that it is, but I mean, it could be. I wish there was a little bit more of a gradual incline of the price change, but it could be easily the symmetrical triangle, so it could either come up or down. So we got to really wait for it to pick that direction, but it's going to happen anytime soon now. So let's go back to Barchart.com. So again, AMC, we got to keep a close eye on that, because it's any time. Moderna, same thing as the Pfizer. Moderna's up a lot, up 20%. And they've got a lot of good news lately, saying how effective they are and blah, blah, blah. 76% call ratio. That's very, very high. Second highest one next to Pfizer. So both of them have the highest percentage call ratios. So basically, this is telling us investors are like almost more than certain that these stocks are going to be the stocks for this week, and that they're going to keep going up. And so, but we got to kind of take a look at their charts and see. We got to take a look at their moving averages and their algorithms and patterns, and see what we can identify there. But this is a great resource to start with. And then the second part of the options area to bar chart is the options volume leaders. So the options volume leaders page will provide us the individual most active calls and puts. So very, very vital to our research and due diligence. So again, Apple's really dominated this list. And then DTE is the number of days until the option expires. So when we look at this Friday, Saturday, or Sunday, we're going to see a lot of zeros. So that basically means that it expired Friday. So now it no longer applies. Doesn't mean anything because it's expired. It's invalid. It's done. It's toast. So we got to focus on the ones that have the numbers. So the Apple call, the $166 that expires this coming Friday, December 3rd, is priced around $139 is the midpoint. But it has the options volume of 106,000, which dominates the entire list. And where the open interest is 79,000. Now, if you're not used to open interest is like an accumulation of volume previously from that particular trading day. So as we go into a Monday, this volume will merge into the open interest, and then the volumes start over. They reset themselves back to zero, and so and then they'll accumulate throughout the day. It just depends on the day's activity. But when we look at the open interest, let's look at this as like people. All of a sudden, we have 79,000 people that may have bought previously. And but now all of a sudden we have 106,000. But because the volume is much higher than the open interest, we have to consider that unusual activity. Because with options volume, we don't always know if it's a majority of buying activity or selling activity. But if the volume is higher than the open interest, that's a dominant indication that is now a majority of buying activity, that people are buying the $160 call because they know that the stock is most likely going to be up higher the next day, or whether it's going to reach the strike price or not, it's going to be higher than what it is now. And so, but if we see something that's a bigger distance, like let's say from each other, like this one right here, we have another Apple call, $166 one, but this one expires at the end of the year in approximately 35 days, and it costs around $463 per contract. This one had the volume of only 74,000 and the open interest of 39,000, just under 40,000. So it's almost double the amount of volume. So it's getting a lot more interest. It's getting a lot more attention. Unlike this Apple call, $162.50, where we can see that the open interest was 51,000, and now the volume is 51,000. This could be people that sold. We don't know. They could have sold that and bought the 160. So this is, even though this may be active, I still would wish we could see that the volume was higher. But we can also see some other things too. Any more significant change or differences? Like this one here's a PFE. That one there had the open interest 77,000 and now the volume of 19,000. So again, that could be selling activity. There'd be people that did buy this. That they could have been selling that. Not sure, but we need to look for unusual activity, things that have a big impact. See Uber's right there, so not a really big difference there. And then now sometimes we can scroll down the list a little bit more and kind of look for something. Here's a PFE there. There's a $56 call strike price. There's only 347 open interest, which means this had no interest, and now all of a sudden it does 15,000. PFE, I think, isn't that the electric company? And it might be the electric company, or no, that's Pfizer. Yeah, Pfizer, not the electric company. So we can see that people are betting that the stock's going to go up this coming week. They're 56. They're staying close to the money. That's probably what, a 5% difference, more or less, which is probably the max that you want to go. You don't want to go too far away from your from the share price when you're picking your strike price. So another area on this website you can go to is unusual options activity. So it'll kind of do some of this work for you if we're looking for a bigger gap distance between the open interest and the volume. So, but I really would like to see more volume, 15,000, 20,000, 30,000, something like that. I mean, we have a 15,000, that's kind of my minimum, I guess. But we also have American Airlines right here as well, so that's also on top of this list. But I don't see anything other than these two really that's kind of gotten our attention, because both of them are affected by this news that the government started to really promote last Friday. So we have Pfizer and American Airlines is showing a lot of unusual activity. Pfizer, a lot of people are betting that the stock's going to go up. American Airlines betting against the stock as we get a lot of travel restrictions. Not good for airlines, so people are betting against it, and so that's where we're seeing a massive amount of pure unusual buying activity on these bets. So another area to this website, we can now go to straddle and strangle. Both of them are basically, they're all the same, basically, where you're betting, you're basically buying both calls and puts. But the difference between a straddle versus a strangle is that the straddle, you're buying the same strike price for the call and the put, versus a strangle, you're buying a different strike price of a call versus the put. Because maybe whatever the share is at $45, and you buy a $50 call and a $40 put strike price. So they're different, but it's the same concept. It's the same idea where you're buying both. So, but with the short straddle, we want to look at all four of these, because again, we're trying to identify unusual activity. And when we're looking at straddling, we want to see a lot of the same stock option. So the first page, looking at this, we see a lot of random straddling stuff, so I don't see anything there. So we go on to the long straddling and wait for that to load, and we want to watch for anything of the same thing. So on this page here, I see 3 AMCs, which we were talking about AMC straddling just a few minutes ago, and now we see PLTR. This is a Palantir Technologies. I think they develop software, whatnot. I see 4 of them on here. And the more that they're clustered together, the better that it is. And so, just like AMC is on the top of this list and is clustered together, so that's good. PLTR is on the list, but it's in the middle, but they're kind of clustered together. There's one that's kind of out, but that's still fine. We got 4 of them, so that's good. So again, AMC PLTR is on our watch list now for straddling. Then we click on short strangle. Click on there, see if we can find anything else. We have AGC. There's 2 of them on the top of this list. I wish there was more. But that's a little CRM. Now, we talked about the earnings report. CRM, that's the Salesforce. They have earnings reports coming soon, and so so it could be very volatile, and that's why we may see more straddling activity with CRM. Then we have Hoods. That's the Robinhood app. It looks like some straddling activity. I'm not sure if there's earnings for them this week or not. We'll have to see if there's anything scheduled for them or not. But there's 4 of them, but they're in random positions. They're not clustered together. So that's kind of a red flag that they're not clustered together. But we do have the fact that there's 4 of them on this list. So that makes it unusual activity that we have to do some due diligence on why Robinhood is on the list. So then we want to click on the 4th one, the long strangle, and see, and then look at that. We got a ton of AMC on this list. So out of everything here, it looks like AMC. There's a lot of people getting ready to straddle this. But now look at the times that we have till this Friday. We have next week on Friday, and then we have another couple more weeks. But majority of them seem to be around, several weeks from now. But look at that, December 17th. So that leads on to the next thing. That just reminded me of something. As we go more into the winter season and the bearish season, as we talked about earlier today, how we're entering, which I call a trifecta of bad news or bearish characteristics as we go into December. Not only did we start off with a triggered event, which could lead into a correction, but as we go into December, we're going to have a lot more meetings from the government and politicians and whatnot, that they want to start increasing interest rates and how soon and when and how much of an increase that they can start. And so there's just a lot of uncertainties there. Plus they're going to start talking about inflations and this and that. But also we have an event that's called the Triple Witching Day. Triple Witching Day is on this day. This is on the December Friday the 17th. So that is when everything expires within the system, and then it starts fresh, whether it's options or whatever, and so that creates a massive amount of bearish characteristics. And so with this whole AMC and GameStop event, it's all about pumping these stocks up, saving companies from going bankrupt, but also teaching certain hedge fund companies a lesson, because in the past, over many decades, hedge fund companies would bet against stocks like Sears or whatever, and as well as AMC or GameStop, and they would post negative news, making the situation worse, causing investors to sell and to cause the stock to plunge, because they had puts. They would bet against these stocks, and as they post bad news, it helped them. It helped them make billions and billions of dollars. So all of a sudden, earlier this year, this Reddit group called Wall Street Bets decided to teach these hedge fund companies a lesson and to save these companies that we all grew up to and absolutely love, to prevent them from going bankrupt and out of business. And we can profit from it at the same time. So lately, it's basically keeping these stocks afloat. Not so much, trying to get to the moon or whatever, but this is a kind of a timing event too, where we need to keep these stocks up as high as we can before the Triple Witching Day, because the Triple Witching Day is the end of these events. Now, the Triple Witching Day happens only 4 times a year. It happens at the third Friday at the end of every quarter. So that would be March. Let me show you. And as soon as I can get another calendar, I'll eventually share it. But this has been this year's stock market calendar. So having a stock market calendar can help provide you what days the stock market's closed because of the holidays or whatever. But for example, with going over the Triple Witching Days are the March, June, September, and December's. So we have the 19th, we have the 18th, the 17th, and the other 17th of December are all highlighted in red. So these were the standard expiration dates for equity index, ETFs, and ETN options, blah, blah, blah. They all expire. So it's very bearish characteristics because they need to get out as soon as we can. But the hedge fund companies need GameStop and AMC to be as low as possible before this date. So this whole Wall Street Bets group and whatnot is trying to keep these particular stocks up afloat and to get as high as we can. That way we can profit from it. But basically, as we get closer to this date, that's when you want to get out, because at that day, I mean, the closer you hold AMC to that day, or the 16th to 17th, that's when the stock is going to begin to go down. People are going to sell, they're going to secure their profits, and after the 17th and throughout the next week, the 20th through the rest of that week is basically AMC is going to keep going down, as well as GameStop, so that's when you want to get out. So it happens just like clockwork. I've watched it happen. I've let our group know about it every time, and everybody's been able to take advantage of it, just like clockwork. And so this is exactly what has happened since the beginning of the year, and it's the same algorithm. And so it's just a little bit of a history of the whole AMC and whatnot. But the whole stock market calendar can be very, very effective. Other than that, that way you know what days are closed, and especially the triple witching days and whatnot. So as we get closer into December, we'll be able to create a new one of these. I'll be able to post it and share it with you guys. And it's just really, really good stuff. More information to master and to get used to. Anything else? Anybody have any questions? Anything you wanted to go over? I think that might be it. There's one other thing I did want to go over with you guys here. Now, I found this about a year ago. Somebody posted this on Facebook. It says fear strikes. Basically whoever posted this on Facebook said basically turn off the TV, wash your hands, and don't worry about whatever the news is promoting. But when I saw this, I saw and I remember every single one of these events. And I remember in the year 2000 we had the Y2K, and everything was going to destroy us. Our computers were going to crash. Your bank accounts were going to go to $0, or it could go to $1 million. Nobody knew. It created uncertainty. Well, the politicians did this on purpose. They created uncertainty because it created massive dips in the stock market system. Then 2001, anthrax is going to kill us all. Al Qaeda's mailing us anthrax in the mail, and if you get some powder substance, call the FBI or your local police station. All of a sudden, Wall Street got a little package or an envelope with white powder in it, and it just freaked out the investors out, and it caused a dip. Well, 2002 West Nile virus, then 2003 was SARS, 2005 was the birds flu, 2006 was the E. coli, and then 2008 was the major financial collapse. So again, you see the little algorithm that we're having every year. The government pours fuel on the fire to whatever it is that'll create more volatility in the system at the right time, and that's usually during the winter time when we have the bearish characteristics. They do whatever they can to make the situation more worse. That way we can get stocks prices lower, providing us a much better buying opportunity. And then so 2009 was the swine flu. It took a couple breaks there for a couple years. And 2012 was the Mayan calendar. 2013, North Korea is going to cause World War III because they kept launching missiles. Well, nothing's changed between now and then. They always launch missiles. And then 2014 was the Ebola virus. 2015 was ISIS. 2016 was the Zika virus. And then between there and then we had Trump. Trump was which is a Republican president. He didn't play any of these games, but however, the only thing he did something a little different. He played more of the trade wars thing with China. That created the volatility that we needed throughout that time, and he did it just like clockwork around the winter time. But the trade wars, it wasn't like any pandemic, wasn't a sickness or anything, wasn't going to hurt anybody or anything. It was just a little bit of bickering or whatnot. So, but just know that every year, just about every year, it's always something, and every 10 years, it's always something significantly something. So whether you're new to trading or been doing this for a while, if you didn't know it, you know it now. So hopefully that makes sense. I don't think I have anything else. Does anybody else have any questions? Want to go over any stocks or anything before we end this? Sean mentioned, is there a good app to use for economic reports? Yeah, foundinvesting.com one. Perfect. Yeah, so it's just not a website. It's also an application that you download. So just go to your app store, type in investing.com, and download it. And it's very, very a critical application. Not only does it provide you very highly valuable news alerts and information, but the economic reports, you can also pull earnings and stuff too. But also the U.S. futures is live, which will begin here in about 4 hours. You can tune into the U.S. futures, and it changes by the second. rather than going to some other website like CNN that updates like every 15 minutes. You can see the changes as it happens. So last but not least, one more thing on the investing.com website. If we go back, there's an article. It changed, and I forgot to post it. But it's every Sunday. They always post the top 5 most important things to kind of to watch coming into this week. So let's see if I can find it here somewhere. Latest. Gosh, it was there. I should have clicked on it, but that's okay. Usually, it's really important to go over the top 5 things that's posted by investing.com, because just in case if there's anything that we missed, they'll talk about it. But normally, when we do our due diligence this way, we usually don't miss anything. Man, I wish they had. I don't know why it's not there. This is really bizarre. But we'll find it here in a little bit, and I will post it in our Facebook group, in our Robinhood's stock market watch list. Everything I post is always in our featured announcement section. It's like our bookmarks. So, be sure to post it on. Be sure to look in there for all my posts that I post every single day. Because I also post things that have to do with activity, especially with options. Pointing out the most active stock options early in the morning, first things. That way you can see, kind of what's going on and where people are investing. And so activity is definitely key. So thank you guys very much for attending. If you guys ever have any questions, please don't hesitate to message me on Facebook. I'm available 24/7. We'll do this again every Sunday, and we can go over recap. And if you, in the meantime, if you guys have any questions, you can message me in the chat room and or personal chat. But all the material I will now begin to upload in the chat room. That way it's there for your reference. If you didn't get it last week, you'll get it today. So just give me a couple minutes. But again, thank you very much, and we'll see you guys next week.
I think this has been a very good informative session with a lot of facts and figures. Thank you so much for that, Carlos. I'm interested to join more of this session to learn more.
Yeah, man, I want to thank you for your time. It was great.
Yeah. Thank you, Carlos.
Excellent.
Appreciate
Thank you
it.
guys so much. Hopefully you guys been able to take a lot of notes. Hopefully this will be a phenomenal, profitable week for you guys. And just remember, always got to try something different. In order to get different results, you got to try something different. The more you learn, the more you'll earn. Thank you guys. Have a good weekend. We'll see you guys tomorrow.